Morning to all, and welcome back to another session of Boutiques on Wednesdays. Well, as Freddie sings, it doesn't matter which way the wind blows, but I think in global equity markets it does matter quite a bit. So we'll find out soon which way the wind is blowing indeed. Global equity was a star performer over the past 2 years, more specifically US equities led by mega cap tech stocks. But uncertainty still remains, with policy uncertainty, election and global political risks that's still on the table. Monetary policy in the US remains tight, while the ECB started cutting rates with inflation slowing. But is this the time for investors to maybe reassess their global regional allocation? Yeah, speaking to global equities and all the way from London, it is my absolute pleasure to welcome Jared Khan from Credo and Ben van Leeuwen, Portfolio Manager at Linsell Train. Good morning, gentlemen. How are you doing this morning?
Morning, Eugene. Doing good, thank you. And thanks for the invitation to be with you today.
Thank you for joining us. A little bit earlier, your side, not too early. So really grateful having you with us, Jared. And Ben, thank you for your time this morning. I see, Jared, your slides up already. Just a quick reminder to our audience, as you know, you're more than welcome to post questions in the Q&A bubble to any one of the presenters, Ben or Jared, and we'll deal with those questions after both presentations. Jared, you're all ready to go, and we are ready for you, sir. Thank you so much.
Great, thanks, Eugene. So, yeah, we're going to start off with the year so far, and pretty much as Eugene has pointed out, we've had a good year, an interesting start to the year. You see the S&P index is up, approximately 15%. The MSCI World Index is up 11%. But when you start looking under the hood, there's quite a lot of stuff that's going on, and it's actually been quite a tricky period of time for fund managers out there. And so just breaking it down into the dispersion of returns year to date, it's really been one-way traffic. And I sound like a broken record because every time I come on here, I talk about the narrow market, the growth stocks, the dispersion of returns, and the unhealthiness of this kind of narrow return, where you have 10 or 15 stocks continually pushing the market up and the rest of the market lagging somewhat. I mean, it's not devastatingly poor from the other stocks, but it's certainly not where the returns are being had. It's just breaking down some of the sectors, and you can see the big sector performance year to date has come from semi and semi-equipments, and effectively that's NVIDIA. And then media and entertainment are two other of the AI stocks, Facebook and Google. And then food and staples is Amazon. Effectively, those are the stocks that are pushing the market in quite a heavy way. And if you look at some of the underperformers, it's still interest rate sensitive type of companies. So auto and companies, and Tesla comes under there, but the real estate and the consumer durables. So pretty much the same as we saw going in to the end of last year. And again, I always, bring up this kind of heat map, and it's just very colorful. And I think it really shows the extent to which the market's moving up and down. And NVIDIA is just incredible. If you look at NVIDIA in terms of the size of NVIDIA, it was at one stage over the last month, the biggest company in the world, over $3 trillion, usurping both Microsoft and Apple. And the return year to date of NVIDIA, over 150%, is just staggering. And that was almost single-handedly pushed up the S&P. In fact, if you look at the Magnificent Seven, I think that contributes now about 60% of the return in the S&P year to date. So if you haven't been in those stocks, you haven't really enjoyed the same success in the index and in your returns as one would expect. And so for a diversified portfolio manager, particularly those ones who are a little bit more focused on valuations and on value as a play, it's quite difficult to capture those returns. So that just gives you kind of the snapshot. And again, going back to this relationship of value versus growth, just a reality check in terms of, are there red warning signs coming up? Do we panic? Do we worry? Or should we be cognizant when it comes to kind of equity allocation? If you look at the blue line is basically tracking 50 years of performance of growth versus value. When the blue line goes downwards, that's when value outperforms growth. And when the blue line goes up, that's when growth outperforms value. And for the period from 1975 all the way till the bubble of 2000, value outperformed growth. And then from about 2008 onwards, you've had a resurgence in growth versus value, particularly accentuated during COVID, where you see a big spike, same kind of spike levels as you saw during the technology bubble in 2000, followed by COVID, and then a massive downfall of growth when interest rates spiked and we came out of COVID. And now you've seen that resurgence again of growth versus value, up to similar levels to where we saw during COVID. And I'm not warning people that this is the end of growth and you need to get out, because the markets can stay rational for a very long period of time. But we are getting to levels where you're getting a disconnect that we haven't really seen over a long period of time. And if there is some kind of mean reversion, one needs to be cognizant that we are getting to levels that are looking a little bit uncomfortable. And likewise, if you just break it down in a similar format, when we look at the S&P index, which takes into account cap weight versus the S&P equal weighted index, you see the massive outperformance of the mega cap stocks versus the equal weighted stocks. And that's about an 18% difference. We've taken this graph from December 2022, and you can see at the beginning of 22, they basically stay, they're performing in line, which is normally what happens. Then you get this big divergence in around February 23 when this whole AI explosion happens. And since then, there's just been this massive dispersion of returns from the mega cap, large cap stocks, particularly, the big seven versus the rest of the market. And this can happen, and it does happen during periods of time, but inevitably what does happen as time moves on is some kind of mean reversion. Again, if you just break it down in terms of, ratings and valuation, if you look at the black line, the S&P equal weighted, going back again over 10 years, was trading on about 15 times PE, now trading, on about 16, 17 times. So the re-rating there is only about 10%. If you look at the S&P index itself, the re-rating there is about 26%. But if you look and break down the information technology index, the PE rating, particularly over the last 3 years, is about 50%. So all of the returns, or should I say a significant portion of the returns that you're seeing in the market, in the big, large mega caps and information technology sector, has come out of re-rating as opposed to earnings growth. And I think that's also very significant. You're getting to levels now where there is a strong possibility of multiple compression or derating. So it's another thing that you just need to be cognizant of. So just changing tack a little bit now, talking about geographic allocation. We know the US has all the large cap technology companies, but looking at our wagon wheel, we look at the MSCI geographic allocation. In the UK and the MSCI world is about 4% allocation. Yet when you look at the Credo Global Equity Fund, we had around 22%. And in terms of North America, we had about 58, 60% versus the MSCI at 74. So we tend to be slightly underweight North America, a little bit more overweight the UK. And clients have said to us, well, why are you buying the UK? What's so special about the UK? So I just want to spend a little bit of time now on a few examples of why we like UK stocks. I don't think the UK economy is particularly exciting. I think with the elections coming up, it should be quite straightforward in terms of who wins. I think it'll be a stable government. I think it'll be positive. You've seen strength in the pound. It's been one of the strongest currency this year. But the picture is not really about UK domestic stocks. For us, it's about a disconnect in terms of valuation on good, wholesome, old economy value stocks versus the rest of the world. And here I'll just bring up the example of some oil and gas companies. If you look at the blue line, that is Shell. You look at the black line, that's Total, which is actually a French major. and then the two American oil majors, Chevron and Exxon. And I think it's fair to say that Exxon's always traded at a premium to the group. But if you focus your attention around about May, October 2014, what you see is that Chevron actually used to trade on a very similar multiple to both Shell and Total. And then all of a sudden you get this divergence of multiple expansion. And I think a lot of that goes down to what I refer to as woke capital, or this whole ESG move. And particularly in Europe and in the UK, you've had a lot of money that's come out of these kind of sectors because of ESG. And you get to a situation, and you're seeing it prevalent in a lot of sectors. You see in the mining sector, you see in the commodity sector, you see it in the gaming sector, where there is a lot of capital that just won't buy these sectors. And so what you get is an opportunity to actually invest. And both Total and Shell have very similar assets to Chevron and Exxon. Good assets, very little exposure to the UK. In the case of Total, very little exposure to France itself. Yet they trade on 7 and 8 times multiples versus the US majors trading on low teens. And so you have expressions from the Shell and the Total management saying, you know what, we don't get a re-rating. We're going to look to relist our companies abroad. We're going to do something to change it. And that's the sentiment that we see from a lot of companies, not just in the oil and gas industry. We've already seen the move from some of the gaming companies like Flutter, which has moved its listing from the UK and Ireland to the US, and others. And so there seems to be a trend that continues. So we think it's a good opportunity to buy some really good quality businesses. In fact, global businesses that do trade on the UK market, don't have the same quality of businesses as internationals, but just don't get the rating. And here, again, I used the example of a few of the UK insurance companies, the bottom two being the grey and the blue, Hiscox and Beazley, and I've just put them up against Chubb and Arch. Arch is one of the Bermuda insurers, and Chubb's a slightly different business and maybe a slightly higher quality business. But what's interesting here again is, although we are, quite deep into the cycle in terms of, in terms of higher margins, it's across the board. Yet we have these type of companies trading in the UK slightly unloved on PE ratios of about 6 and 7 times versus the US players, again, trading between 13 and 15 times. And again, we're seeing these as opportunities where you can buy UK businesses, good quality businesses at significant discounts. And the last stock, which is maybe slightly different because this is a big global player, but we think it's a great opportunity. I know Linsell also owns a stock, is Diageo. Diageo is obviously a drinks company, has some of the best drink brands in the world, like Johnny Walker, Guinness, has a fantastic tequila portfolio. And if you look at the blue line in terms of valuation, this is the cheapest that Diageo has traded in almost a decade. And yes, it's had problems. It's come out of COVID, having had a massive tailwind, which has now turned into a bit of a headwind. You've had selling pressure from the likes of the GLP frenzy. You've got worries about overstocking in the US and margin issues. But inevitably, when you're looking for great quality companies, you need to buy these stocks when the market is down and out on them. And I think this is a great opportunity to be buying Diageo. So it is now, I think, the 5th biggest holding in our portfolio. And we're very excited long-term about the prospects for this business. I think I'm almost done time-wise, but again, quick snapshot in terms of where we are in the portfolio. This is not your typical, big mega cap 7 stocks. We do own Microsoft, we do own Alphabet, we do own Meta, but that's about it in terms of the technology in the portfolio. And quite interestingly, again, if you just look at the valuation of our portfolio versus the MSCI World and the MSCI Growth Index, we're on a blended P of about 14 times, values slightly lower than that. The MSCI is at 18.5. And the growth index, looking quite peaky at 26 times. So again, global equity fund playing at the intersection of value and quality. We do what we say on the tin, and if you're looking for something where you're going to get some kind of downside protection if growth does start capitulating, I think the fund's in a good place. And I think I'm going to sign off on that note, Eugene.
Many thanks, Jared. Thank you for that. We're going to take some questions afterwards. Ben, if you can start sharing on your side. Yeah, your presentation coming through.
Brilliant.
And full screen mode. Perfect. Thanks, Ben.
Thanks very much, everyone. And thanks, Jared. Very interesting as ever. Yeah, today I'm going to be talking about this idea of Kaizen, and just a flag at the outset, it will be fairly company focused and less macro orientated, but I'm sure we can deal with both in the Q&A. 3 slides of disclaimers. So I thought I'd start with a few slides just to remind everyone about the Linsell Train philosophy and approach. And at the heart of what we seek to do is to behave like true business owners. For us, that means incredibly long holding periods. So as you can see over the history of the strategy, over 13 years, we've actually only bought and sold about 5-6 stocks on both sides of the ledger. And that means that we have a portfolio turnover of about 5%. So that implies this 20-year holding period, which we think is fairly all important. And the reason we have been able to maintain that level of turnover, which is unusually low, is that we only seek to invest in this nirvana of high quality companies. And the classic proxy for that would be a high, but crucially a sustained return on equity over time. And as you can see from this slide, our companies in aggregate, on average, have not only managed to maintain return on equity that is double that of the index, but they've maintained that delta sustainably over time for a modest valuation premium. And this is the slide which explains why we think this approach makes sense and continues to make sense. And it's just a small worked mathematical calculation, but it shows that if you can find these high quality companies that are able to sustain this high return on equity over time that we've just demonstrated, then you are able to pay a premium. And not only that, but you can see that premium revert to the market mean over time, and yet you will still lock in a level of outperformance thanks to that superior internal compounding. And that is in the worst possible scenario into that headwind of reduction in valuation, which by all means is not guaranteed. But hopefully that kind of illustrates at a high level what we're seeking to do. There aren't many of these high quality companies. Luckily for us, we think they are over concentrated to certain parts of the market. So if you look at the left-hand side there, we find an above average concentration of them in areas like software and beverages and information services. And if you look at the bottom of the slide, I've shown our universe versus the index. And it shows that 91 out of our 140 names in our universe are concentrated in those areas, compared to just 17% of the MSCI World Universe. And on the right-hand side, the areas we typically avoid make up just 3% of our universe versus almost 53% for our benchmark comparison. So the short answer there is that our results are going to look extremely different from the index, and we have this high active share. This slide just hopefully corroborates what I was trying to explain when I was saying that certain areas of the market have almost, this structural higher returns. It comes from a McKinsey study that it's slightly old now, but it's well cited, and they looked at the return on invested capital for a range of industries across 40-50 years, and you can see that areas like pharma and software and all the places that we continue to think remain the most attractive today were also the most attractive over that whole period and managed to sustain these incredibly high returns with quite nice tight bands as well. So it really is a structural trend to get behind. So far, I imagine a lot of what I've discussed may sound fairly familiar, but this is where we take it one step further, hopefully. And an important way that we've sought to generate excess returns beyond just investing in high quality companies is to look for long-term options for self-improvement. Hence this title of Kaizen, this Japanese word for self-improvement. And the best way to illustrate this is a great study by a man called Michael Mauboussin. And I've named the study at the bottom of this slide. And he looked at total shareholder returns for a range of companies that managed to massively change their quality, which he measured by return on invested capital. And it's a fairly number heavy table, but basically what it shows is that he took the Russell 2000 index over kind of 30 years, and he looked at companies that started in the worst quartile as measured by their return on invested capital. And you see that on that axis there, but ended in the best quartile. And as you can see from the green circle, they managed to secure the best rolling total shareholder return. And in a beautiful act of symmetry, the inverse was also true. If your company started with a fantastic return on invested capital, but ended in the worst quartile, you locked in this underperformance. And I'm sure that's all fairly intuitive, but it is something we have taken deeply to heart, that there is exceptional returns to be found if you can find these companies that are able to keep iterating and improving. And I thought I'd give you a few examples of what I mean by that across the portfolio at a company level. So RELX, one of our most important information services company, owner of academic journals and legal data and so on. 40, 50 years ago, it was selling dumb case study law books and legal databases. And now on the glossy MacBook, on the right-hand side, it's selling Lexis Plus AI, which is an AI-enabled kind of companion for lawyers that will help them summarize cases, analyze the past records of judges, and much more besides. So the self-improvement journey for RELX has been this ability to keep improving the value and utility of its content through technology over time. For FICO, our second most recent addition to the portfolio, the self-improvement story there has really been about unleashing its incredible pricing power. This is the owner of the FICO credit score, and they spent decades, since the 1960s, selling credit scores for next to nothing and really making sure they were fully integrated in the US credit ecosystem. And then around 2016, with a new CEO called William Lansing, they renegotiated their contracts with the credit bureaus and managed to secure untapped pricing power. And you can see at the bottom of the screen there, the effect, the before and after of what that has meant for their revenue growth. And there's a very, very long secular runway ahead for this company. Then this is a wider theme across two industries, which is our information services companies like RELX and the London Stock Exchange Group, and our media companies like Nintendo and Disney on the right-hand side. But the self-improvement story here has been how changes in distribution are making the revenues earned by all of these companies even more sticky, recurring, and therefore valuable. So for RELX and the London Stock Exchange Group, as you can see, the vast majority of their revenues are now these long-term recurring revenue contracts where they sell this mission-critical data. And for Nintendo and Disney, which you wouldn't think are natural bedfellows with the other companies on this slide, but historically they have been more volatile and tied to the success of any one game or console or movie. But now that they've started selling their content direct to consumers, frequently through these kind of recurring monthly subscriptions as well, that volatility is starting to subside and they have a higher quality revenue mix, and that continues to improve. And then just finally, this is our luxury name, Prada. I've shown a decade of results here, but we invested in around 2020. And what we saw here was a clear improvement for their margins at the main. And we thought that they could get not only back to where they had been historically in the kind of mid-teens, but even to 20-30% plus in line with their peers, if they managed to finally take e-commerce seriously, rationalize a slightly bloated store count, double down on leather goods and handbags, which is the highest margin segment of their market, and rationalize a bit of distribution. And very gratifyingly, that has already started to happen. But we're never looking for a kind of 2 to 3 year turnaround. These are kind of secular trends over a much longer period. Just in case you thought I was only showing rosy examples, I thought I'd just include one counter, which is Shiseido, our Japanese cosmetics manufacturer. We invested in the early 2010s, and much like Prada, we saw that relative to its peers, it had a number of opportunities for self-improvement. And again, the initial 5-7 years were very gratifying, and they made a number of very sensible moves. Unfortunately, the gray block, the gray shaded area happened, which is COVID. And that really stymied them. You know, travel retail was shut down, and that really kind of impeded their efforts for a couple of years. And they have had to push out their targets a bit further into the future. We still, though, think the underlying potential is there, and we remain patient holders. And then just to finish, I've talked about this idea of self-improvement on a company by company level, and hopefully shown the importance of how that can lead to higher returns. But this improvement principle also applies to us at the portfolio level. So I thought I'd walk you through our most recent instance of turnover. We sold a company called Japan Exchange Group, which is a phenomenal company. It has kind of regulator-supported monopoly positions across equity and derivatives trading in Japan. It's going absolutely nowhere. It's been here for several hundred years. But it is tied to the cyclicality of the Japanese market. It hasn't really managed to diversify into higher growth data and analytics areas like other exchanges. And when we exited, it was at a very elevated multiple because of this recent exuberance for the Japanese market. And in its place, we bought Universal Music Group, which is the world's largest music entertainment company. It's basically a collection of incredibly valuable music labels. And in UMG, we saw a higher recurring revenue mix, which we really appreciate and like, better growth opportunities, and a really interesting store of evergreen content that continues to get more valuable. So I thought I'd just wrap up there, and hopefully that illustrates that, yes, at the company level, we want to see ongoing self-improvement, but for us as managers, with every single change to the portfolio as well, we're always looking to improve the LT portfolio and improve the average quality of our holdings through very rare but deeply measured and careful turnover.
Ben, thank you very much for that. Indeed, insightful. Ben, if I can maybe start with you very quickly. And I mean, we've seen a lot of presentations from Linsell Train in the past, and we know that Linsell Train is all about, you know, wealth creation and creating wealth for investors. And I think it also speaks to how you construct your portfolios, and definitely highly concentrated portfolios. You run anything between 20 and 25 stocks. We learn at the other end of the side, you know, if you want to protect capital, you know, look at diversification. But again, with the focus with Linsell Train on wealth creation, do you think that a high concentration portfolio does add to shorter term volatility, or doesn't it really matter?
It's a great question. For us, it probably does, because not only are we only concentrated on these 20 to 25 names, but they're very much not across 20 to 25 sectors. They are very much connected to three main themes: our consumer and healthcare staples, our media and intellectual property content, which we include some of our technology companies, and then our financials and networks, so our stock exchanges and our payments companies. So that does mean that when an entire sector does well, whether that's energy or materials or utilities, we don't participate. So it can be a slightly more volatile ride. But for us, we just think it makes sense to really not diversify too much into areas that we don't have as much of an edge in analyzing, and focus on our kind of mainstay areas that we've analyzed for 24 years now.
And I mean, your history showed that, indeed it does add wealth or add value to investors. Jared, maybe just very quickly, I mean, all eyes were on the Magnificent Seven, or rather six now, for the past 2 years. Everything dragged up by mega tech, mega cap companies. But I mean, there's a lot of other disruptors in the market, and I mean, you've presented at length on things like GLP-1 drugs. You've shown companies like Eli Lilly and Nordisk. I mean, they massively outperformed the MSCI, and they outperform most of the mega caps as well. So there's really good companies to be found out there. As far as I know, you don't hold either of those at the moment. You can correct me if I'm wrong, because I mean they're trading at extremely high multiples at the moment. But what in that space, almost like the new generation type companies, or the competition coming to the fore that you're buying at the moment, where you see that are disruptors and can actually add massive value for investors?
Well, Eugene, I mean, the truth is very few, if any. And the main reason is it just doesn't kind of meet our investment philosophy or our strategy. We don't tend to buy growth stocks in the sense that, that they're going to grow into these massive expectations of earnings, and they trade on high multiples. So what we do buy is what we think are great quality businesses that within their portfolio have something there that could turn into something quite fantastic. And so an example of that would be Disney, which we did buy, I can't even recall, maybe 7 years ago, or even longer, when we identified, their catalog of movies and whatnot that was significant and had a competitive advantage and was a real player that could take on Netflix. And so this was when they were just about to launch their streaming business, and there you were paying next to nothing for that business, yet Netflix at the time was trading on 100 times. So we like to buy companies like that where they have within their portfolio great assets, and so we cut our teeth negatively on something like Intel. That was about 4 years ago, where we thought Intel was the incumbent. They had all the technology. They could take on AMD at the time. It wasn't even NVIDIA, and they couldn't. And we cut that position. So we'd rather tend to buy these businesses that have the technology, they have the foresight, they have the capability, yet not pay the multiples, and hope that if they get the technology right, then you get that significant upside. And I think that's a far safer way to play it. And yes, clearly we're missing great returns, but I can send you, 9 out of 10 graveyard stocks that are in that sector that you've paid these premiums for, and now trading literally at a 90 to 95% discount on valuation to where they traded historically. And that's the problem when you're buying and chasing these high quality growth stocks or low quality growth stocks in those instances.
Very interesting indeed. Ben, I mean, if you look at the whole tech story over the past 2 years, a lot of clients feel they missed out. But I mean, as Jared rightfully showed, a continued disconnect between growth and value. People are getting a little bit nervous, and like I mentioned in my introduction, maybe a good time to really revisit your regional allocation, the kind of stocks that you or fund managers you carry in client portfolios. But I mean, from a Linsell Crane perspective, how do you position for that? If you see these kind of companies flying off into the distance, magnificent returns. I mean, how do you keep sane in terms of what you hold in your portfolio, and how do you stick to your guns?
Yeah, I think starting with the kind of true business ownership mentality helps. It's an input, not an output, but we do really stick with our conviction. So we don't tend, as a style, to get shaken out by any one trend, and that's worked historically over the past. We do participate. So FICO is never really included as a kind of bona fide technology stock, but that's almost tripled over the last couple of years. And yet the risk there to kind of new technology is next to nothing. When we initiated, there was a kind of AI-enabled competitor called Upstart that was going to revolutionize credit scoring through AI. And I'm afraid that's in Jared's bucket now of a minus 90% kind of return. And the fact is, we like technology that is old technology. So credit scoring hasn't really innovated since the 1960s. You put in 8 ingredients or so on, it spits out a score, a 3-digit score, and that's your credit worthiness. And we just people haven't managed to really massively improve that. So when we can find a technology company that's survived for 50, 60 years and fended off new incumbents and can still compound growth at 30%, that's great. That's kind of where we'd like to be. And just more broadly, Jared kind of highlighted Disney's content. We think content is a great place to play. So Universal Music Group, Disney, Nintendo, they all own phenomenal franchises. And it doesn't really matter for Nintendo whether or not their new console has 4K or 5K resolution. UMG don't really matter which streaming service wins, or if it's the Walkman or another form of streaming content. The thing that kind of wins out through all of these is that great content continues to get more valuable, and people really keep listening or watching the stuff that they really love. And we think we have 3 really important holdings there. So yeah, if they can keep benefiting from technology while owning those mainstay franchises, we feel a lot safer.
Ben Linsell try and also have you've got a Japan explicit equity fund as well. We don't host a feeder for that, so we've got a feeder for your global equity. But in your global equity, you also have Japan exposure, if I remember right, roughly about 18%. And again, correct me. Your views on Japan? I mean, you've seen a good run on Japan, but some would say it's the currency is undervalued, but the stock market perhaps a bit pricey. What do you buy in Japan? What are those holdings?
Yeah, really interesting. It's been a really weird market to observe.
Yeah.
There's been a number of times historically when there's been touted governance changes. This most recent cycle seems to have had a lot more teeth. We go out there, we visit these companies. We think there are actually, companies trading below book are now kind of sweating the collar and seeing what they can do about it. It's a weird market. There's a big bifurcation. You've got these lower quality companies that are trying to self-improve, but from a bad starting point. You also have a highly concentrated, very expensive end of the market where everyone recognizes the incredible qualities of a Keyence or a Fanuc or something, and you get these incredibly elevated multiples. We kind of play, I'd say, somewhat in the middle. We want these high quality companies, but we don't want to have to overpay. And we also want high global exposure. So Nintendo happens to be listed in Japan. And yes, every single Japanese teenager has a Switch, but the vast majority of their earnings are the US and overseas. Yes, it has been a fantastic run. Yes, we've massively benefited through our holding in JPX. It's a direct line to the health of the cash equities trading market in Japan. It's been a boom period. We have chosen now to step back from that one. Let's see how long it continues and so on. But yeah, we're happy with our Shiseidos and our Nintendos and some of our other luxury personal care goods companies there.
Very interesting indeed. That, like you said in the beginning, you do pick up a lot more different things than the typical MSCI. And maybe it is time to revisit. Jared, the graphs you showed in the beginning, I think a lot of investors a bit frustrated with that. since 2008 right through to 2012, I mean, we've seen a spur in launch of big quality or growth funds, and they've done phenomenally well. And since then, you know, it's almost like the tide was in their favor, with likely the longest business cycle the US has ever had. Do you see the tide turning at some stage, and what do we need for that tide to turn?
Uh,
Can we time it, Jared? No, we can't.
no, so I mean, I'm not going to be a growth doomsdayer. I mean, growth is a great strategy and it's working. And the companies within there are, you know, you can't fault them to a large degree. I'm very much a believer in some kind of mean reversion, and just, you know, going back to the one graph, you just got to go back to trend lines. If the dispersion of returns between growth and value, or the relationship between growth and value, just comes back to trend, which still means an outperformance of growth over value, you should see a significant uptick in the value aspect. You know, and I can't quantify it, but it would be somewhere between 20 and 40% outperformance. And we saw that in 2022. And you can see that from, you know, the various fund performances, including the Global Equity Fund, where, you know, you have a very, very sharp sell-off in growth, and value just holds the line. So for that to happen again, I'm not sure. I mean, in 22, it was interest rates, it was the unwind of COVID. For now, I think money is expensive, so interest rates, if anything, are going to come down, which should actually be a tailwind for growth, not a headwind. I think just what happens is earnings start disappointing, maybe, and the market starts realizing that the valuations they're paying are a little bit excessive, and you just get you know, money leaving the sector very quickly. And you've seen periods where you get this rotation, and it happens in a matter of days. And if you're not positioned properly for it, you effectively miss the big upside changes. So, as I say, I'm not a doomsdayer for growth. As I say, I love those stocks. You can't fault those stocks. They're fantastic businesses. They're just expensive. And I think you've just got to be diversified. You've got to have a shoe in each corner, and you've got to be balanced, because when it does happen, if you miss it, you've missed it over the first couple of days or weeks or so.
Two very good examples of picking up something different in the market. I always tell investors, you know, be careful of what you're buying. If you continuously buy more of the same, you could get caught with your pants on your knees. Gentlemen, thank you so much for your time this morning. We're really, really grateful. Ben from Linsell Train, Jared from Credo. Both the feeder funds are available on all the big platforms. If you want more information on the portfolios or the funds, please get hold of the BCI sales team or give us a call, and we'll get you or steer you in the right direction. Jared, Ben, thank you again for your time this morning. We are very grateful, and we'll chat to you again in the very near future. Thank you so much.